All right, let's get right into it. Every single person who invests, whether you're a Wall Street pro or you're just starting out, you're wrestling with the same huge question. Is putting my money in the stock market actually worth all the stress? Are the potential rewards really big enough to justify the risk? Well, that's exactly what we're going to unpack today.
So let's frame this up. It really all boils down to one major decision.
I mean, really think about it for a second. Over here, you've got stocks, right? They've got all this potential for huge growth, but also a ton of volatility. And then over here, you have government bonds, the slow, steady, and let's be honest, kind of boring, but much safer option. How on earth do you make a smart choice between those two?
Well, what if I told you that there's an actual tool for this? A specific metric that finance pros use to cut through all the noise and give you a really logical place to start making that decision.
It's called the equity risk premium, or ERP for short. And all it is really is the extra money, the premium, you should expect to get for being brave enough to invest in the stock market instead of playing it safe with something like a government bond. It's basically your reward for taking the plunge.
And look, this isn't some dusty academic idea. Investopedia calls it a critical metric, and they're right. It's a tool that helps you put a number on that gut feeling, turning that big, scary question of risk versus reward into something you can actually work with.
Okay, so if this number is so important, how in the world do we figure it out? Let's play detective for a minute and break down how to calculate it. It's actually a lot more straightforward than you might think.
You can boil the whole investigation down to 3 simple steps. First, we've got to make an educated guess about what stocks are going to return. Second, we need to find the return on a risk-free investment to compare it to. And third, we just do a little bit of simple math. That's it.
Now, I'm going to be real with you. Step 1 is by far the hardest part. Why? Well, because it means we have to try and predict the future, and we all know how that usually goes. But luckily, we do have a few solid methods to help us make a pretty good guess.
So to make this educated guess, analysts have a few tools in their toolkit. First up is the earnings model. This one looks at the earnings yield, which is just a fancy way of flipping the PE ratio upside down. Basically, it asks, for every dollar I invest, how much profit is the company making? It's all about the bang for your buck right now. Then there's the dividend model. This is the show me the money approach. It looks at the cash dividends a company pays out and then tries to guess how much those cash payments will grow over time. And finally, you have the PEG ratio. This is cool because it looks forward. It compares the PE ratio to how fast the company is expected to grow. It helps answer the question, is this stock's price actually justified by its future potential? By looking at all three, you get a much more rounded picture. Okay, so we've done the hard part of forecasting. Step 2 is a walk in the park by comparison. All we need to do is find our baseline, our safety net, the risk-free rate. So what's a risk-free rate? It's the return you can get on an investment where there's pretty much zero chance you'll lose your money. The classic example is a U.S. Treasury bond because, it's backed by the full faith and credit of the government. For our little investigation here, we're going to use an average inflation-adjusted rate of 1.7%.
All right, we've got our clues. We have our estimated stock return, and we have our risk-free rate. Now it's time for the big reveal. Let's put it all together.
And here it is, the final calculation. It's just simple subtraction. We take our estimated range for long-term stock returns, which is somewhere between 3.7% and 4.7%. Then we just subtract that risk-free rate of 1.7%. And voila, our equity risk premium. That number, that 2 to 3%, is the magic figure. It's the extra return that stocks need to give you over and above bonds to make taking that extra risk worth your while. So you're not just looking for a positive return. You're looking for a return that can clear this hurdle.
But hold on. Before we take that number to the bank, any good investigator knows you have to question your own evidence. Because like any forecast, this calculation has some big assumptions baked in that we absolutely need to talk about.
I really like how this is laid out. On the left, you've got the safer bets. For example, assuming that over many, many years, stocks will probably do better than bonds. History generally backs that up. But on the right, that's where it gets shaky. The idea that current stock prices and PE ratios are somehow correct and will just stay that way? Wow, that is a huge leap of faith.
And really, that's the bottom line here. This whole model is built on predicting the future. It's a fantastic guide, an amazing thinking tool, but it is not a guarantee. Anyone who tells you they can perfectly predict what the market's going to do next, well, they're probably not telling you the whole story.
So we've done the math, we've talked about the flaws, let's get down to brass tacks. Why should you, as an investor, even care about this tool? What's the final verdict?
And that's a totally fair question, right? If it's not perfect, what's the point? Well, the point isn't about finding a perfect, magical answer. The point is about making better, smarter decisions.
It really comes down to two big practical benefits. First, it can help you spot a potential bargain. If you analyze a stock and think its future returns will blow past that 2–3% premium, you might be looking at an undervalued company. And second, maybe even more importantly, it's a great warning sign. If a stock's expected return doesn't even clear that basic hurdle, it could be way overvalued, and it might be a good idea to stay away.
At the end of the day, that is the most important thing to remember. The equity risk premium is not a crystal ball. Think of it more like a compass. It's a powerful guide that helps you navigate, forcing you to think critically about risk and reward before you put your hard-earned money on the line. So yeah, the formula itself is just simple subtraction. The future, on the other hand, is anything but simple. This tool gives you a new lens, a new framework to ask a better question. Not just, will the stock go up, but is the potential reward here truly worth the risk I'm about to take? And how you answer that, well, that can make all the difference.